I want to start by saying personally that this is among the most useful and actionable podcasts I have ever done. Fergus Cullen is an absolute genius when it comes to analyzing markets and finding undervalued sectors spring-loaded to pop. I want to call out the audio issues, which arose most likely because we were 9,000 miles apart during the call, but do not let that get in between you and the valuable information he shares. Throw in some subtitles if you have to, because we do a deep dive into several apparently undervalued stocks that seem primed to rip, and it will certainly be worth your attention. So here's my call with Ferg. So I want to welcome to the show the successful trader Fergus Cullen, who goes by Ferg. You can find him on Twitter at the @TraderFerg handle. I'm super excited to have him on because he knows how to find deep value, and we only want to find things early before anyone else wants them. So welcome to the show, Ferg.
Thanks for having me, Elliot. I'm glad to be here.
So I was going to start with something else, but I just came across an interview of you talking about Noble Corp. And I looked into it and I was like, wow, this is an 8-cent stock. It used to be $50. And you're saying it has bullish fundamentals. And I'm like, well, I got to ask you about that. So if you wouldn't mind, could you tell us kind of why you think it has bullish fundamentals?
Yeah, well, the first thing to point out quickly with that is that that's the stock trading in bankruptcy, so you don't want to touch that. So when a stock goes into bankruptcy, it trades with a Q on the end, and then gets shifted onto the over-the-counter market, and that's the Chapter 11 proceedings are going on, which is usually the senior debt holders or debt holders sort of negotiating with management and working out who's going to take the hit and who's going to get wiped out. So you never want to touch anything with a Q on the end on the OTC market, because with Noble Corp, for example, those guys are going to get wiped out, and debt holders will become the new equity holders when it relists. So it's going to relist this quarter. So yeah, with that out of the way, I love it just because these are inherently terrible businesses to start with. So got to get that out of the way, that these are companies that just have a huge amount of assets that they all buy with debt. They incur a heap of debt, and then they're a marginal producer. So they contract out to the oil majors. And from there, when the going's good, their day rates, which is how the sector works. So there's utilization and day rates. So it's like, I always like the analogy, it's like a taxi company. So if you want to start a taxi company, you also have to buy a whole lot of taxis, you incur a whole lot of debt. And then from there, your earnings are really a factor of utilization. How many taxis do you have running at any particular point? And from there, the day rate, the best way to think of that, something like Uber's surge pricing. If you obviously had a certain amount of utilization, then you can surge price the hell out of your whole fleet, because everyone's sort of at full utilization, and that's how these things just make an awful lot of money in a very short period of time. And then when there's oversupply, they go back to being a horrible investment, as they have been the last decade. And what is especially interesting with that to me is that these companies, having now gone through Chapter 11 or a restructuring, they've wiped out that debt burden. So the senior debt holders went in with 3.5 billion of debt, and they're going to have a debt for equity swap. So they will become the new equity owners in the relisted vehicle that relists on the New York Stock Exchange in the next few months. And they'll also partake in the new notes, the new debt moving forward. All the original equity holders get wiped out. And so what you have is the debt goes from 3.5 billion to just over 300 million. You've got no debt maturities out for 5 years. So your debt servicing goes down about 90%. You've still got your backlogs. So they've got 1.4 billion of contracts. So what you have is a highly de-risked vehicle that still has extreme leverage to oil. So when oil goes higher, these are the guys that get engaged. So if you share my view that we're probably going to see oil in triple digits in 2022, then the fact is that these guys will be a highly asymmetric play with little downside at the moment.
Sure. So is this company your favorite in the offshore drilling space, or are there others that might be less risky and still have value?
So I just concentrate on Noble because they're the first to sort of outline the proceedings of their Chapter 11. So I honestly like Diamond Offshore better, but they haven't even advised when they plan to come out of Chapter 11. So there is kind of the issue with if everyone catches on to the sort of reflation and commodity trade, that these things won't trade as cheap. So I've just focused on Noble because it's going to be the first way to get exposure to this.
And then, but looking back at it, I'm saying like, okay, well, what was the business like at its peak? And even in 2016 from 2016 to 2019, it was just losing gobs of money every
Yeah.
year. Do you think that'll change in the future, or do you think it'll just continue being that type of business?
So you just got to remember these are marginal producers. So these businesses that they're highly cyclical. So that's kind of where I position myself at the moment, as I like what I call like the hyper cyclical businesses. So these businesses which just purely by design they lose money for long periods of time. They're not your value plays that you have a nice sort of free cash flow and return on equity year after year. These are ones that just when a certain circumstance, which is the commodity bull market, appears, these guys are perfectly positioned to make a lot of money. So I see them, you can get in where they're absolutely hated, which they obviously are. Anyone that's invested in any of these offshore, bar a handful, has been wiped out or will be wiped out in the Chapter 11 proceedings. So yet you get a highly de-risked vehicle, which is very low risk when it's got no debt maturities for 5 years. And they, with my view of where oil's going on the back of shale imploding, and essentially it's just over projecting renewable trends, then these guys, yeah, will stand to make a lot of money on sort of a 2, 3, 4 year time frame.
So that makes a lot of sense. So my first question is just, so you said it's going to come out on the New York Stock Exchange under what ticker?
NE?
NE, okay.
Yeah.
And what do you think its market cap will be?
So that'll be up to them. That'll just be negotiations between management and they'll just be judging sentiment of the market. So I wouldn't even hazard a guess. Yeah, it's wrong to look at the OTC because that's just the amount of people hanging in there is what it's being valued at. So that's people that don't understand that that's going to be wiped out, kind of like the guys playing Hertz. They're just all sort of picking up pennies in front of a steamroller because there's no way they're going to get a good outcome, sort of the bankruptcy proceedings. Yeah, because that's all the OTC is people can go in there and you're just betting that the company will favour the original equity holders, which history has shown almost never happens.
So that's why it went from in the last 6 months, it went from 2 cents to 8 cents, because you're saying some people think the equity holders could still get some value.
Yeah.
Okay.
It's just speculating.
Okay.
Yeah,
or they just don't know.
You can have the same argument with why are people even in Hertz when that business is cooked for the foreseeable future, and they can't overcome their debt load pretty much under any circumstance, and yet people were piling into it. Just ludicrous.
Yeah, I know, totally. So for Noble, like when it does come back, when it comes on the stock exchange and it's listed, is there a valuation that you would say, why would they value it that high? I'm not gonna buy it here.
I will never say never, but it most likely won't happen because the senior debt holders that have now become equity holders have a vested interest in it going higher. So most likely they'll price it on the low end, I'd guess. So we'll see what they come out with, but I'd be more than happy to guess it. They've given themselves a very nice deal so that they can, because these guys have obviously lost a lot of money on their debt holdings, so they're looking to make it back on the equity.
Yeah. Okay. So that's good to know. I guess historically, when they come out of bankruptcy, they're never trading at a premium. So that'll be good to see when that happens. Excellent.
Especially with the market still hated. Like try and pitch someone offshore when everyone else is still in bankruptcy, and that's why I'm hoping they relist sooner rather than later, because I'd hate for there to be a real change in sentiment in the oil market. Hopefully relist in the next month or two, then they should still be priced like a bargain, because everyone will just sort of have that same sort of revulsion of them knowing that everyone else has lost their money in them.
You're right. So it's true that it's all kind of based on the oil price. So why do you think that the oil price is heading for triple digits in the next few years? And I'm only asking because I live in America and they're about, the Democrats are about to unleash this massive spending on green energy and they're going to be anti-oil. So what is your bull case for the oil to get to go up in the next few years?
Yeah, well, so that now you'll take me off on quite a rant on my whole oil view.
Yeah.
But to start with, you've really got to understand that oil demand's going nowhere. So a lot of people like to sort of roll it over and say that renewables are going to be 50% of our total energy production by 2050. And I just don't see that at all. So you break my argument down into probably three parts. The one part is demand, the next part is shale, and the other part is sort of the renewable EV side of things. So to start with demand, you need to understand that everything you generally see projected is from the developed world, which is kind of misleading because the developed world is the minority. So we're 1.3 billion people. We consume about 13 barrels of oil per person per year, whereas the developing world is 6.5 billion people, and they consume about 3 barrels of oil per person per year. So if you assume, like the EIA does, that just on population growth, so they stay at 3 barrels per person in the developing world, then that increases the energy system by 50%. But if you assume, which I don't think is a large jump, that they increase their standard of living slightly, nowhere near what we are experiencing, but they increase from 3 barrels of oil to 4 by 2050, then that doubles the entire energy system by 2050. So once you understand that, you start to realize that we've actually really got to be installing an awful lot of energy to keep up with this demand. So anyone that has energy demand sort of rolling over or anything like that is just completely missing this trend. And from here, I'll sort of go on to renewables, which is ultimately, I think renewables are going to be a large misstep in history because energy density does matter at the end of the day. Renewables haven't worked as we've seen in California, South Australia, Germany. Germany, for example, spent 580 billion and they've barely replaced the energy that they've taken offline. They've had no notable impact on emissions. Their energy is now twice as expensive as France, and they're starting to have serious issues with downtime. It was November, December last year. They had to import the majority of their power from neighbours like the likes of France on nuclear. And the same goes with Denmark. Everyone loves to say, well, look at Denmark, in which it's got its renewables up to 60, 70 odd percent. But everyone forgets that when they have downturns like in windless days as such, then they can import power from the likes of Norway's hydro and Sweden's nuclear. So it really is, it's the kind of the volatility that renewables create. You start to have real problems because you have also got the fact that not only do you have capacity factor, which is the amount of time that they can actually generate electricity. Like if you're talking about a 100 megawatt wind farm, it's not actually generating 100 megawatt. Its capacity factor might be 20 or 30%. So it's only producing 20 or 30 megawatts, and then it's producing that unreliably. So you have to have a backup, and there's costs involved with that. If you've got a gas plant that's only going to run 20, 30% of the time, and there's cost of that. You've got integration costs, like to join these into systems that were never designed for oversupply, undersupply, like balancing costs, ramping costs. And when you start to sum up all these costs, you realize that it's actually hugely expensive. It's really misleading how they always use the levelized cost of energy as the example of why renewables are so cheap, because that's kind of like, I don't know, the analogy would be it's like quoting the cost of a flight and leaving out the pilot and half the fuel. It's not the full cost. And so, yeah, renewables are, I think they're going to severely disappoint. And also the last point to make, some of the biggest renewable projections are in China and India for massive uptakes, and that's going to be what rolls over a lot of like coal, oil, and even natural gas to an extent. And if you can go do a little exercise and go on windatlas.com, and you see that if it's not working in the likes of Germany and Denmark as such, when they have some of the best wind conditions in the world, you look over at China, and China is actually largely windless. So it's a terrible setup for renewables in the first place, even when they're not working in their current pilot schemes in the likes of Germany. So that's kind of a really quick run through. I've got a blog, but that's just a quick run through. The next factor of why I think oil's going a lot higher is shale. And so shale is super important to understand, especially when you realize that it's been 90% of the additional production brought online over the last decade in the oil market. So we almost did have a shortage back in sort of around the 2008 to 2010, and that was going to create a sort of an ongoing oil bull market until shale just exploded onto the scene and produced an absolute ton. So it ramped from 7% of global production to about 16, 17, went from 5 million barrels a day to 13 at its peak. But the problem with that is it's never actually made any money, as the sort of the management were misincentivized to keep growing production at any cost. And that's resulted in a few things that's quite common. What you see in the mining industry is called like high grading. It's when you essentially keep increasing the wells, that you keep grading them up higher and higher. So you're essentially cherry picking your best resources. So, and so like just to give you an example, in 2014, 15% of the wells were tier one, which is 400 barrels a day. Take that through to 2018. Now 70% of the wells tier one, and they're producing 625 barrels a day. And as of now, it's about 80% tier one. So you're really just cherry picking all the good resources, and you're claiming it's down to increases in shale technology and productivity, which don't believe it is. And so the thing is, with the current crash we've had, they've got this massive problem with high grading, and then they've also got a massive problem with they won't get the easy access to capital that they had last time around, because now you've got ESG mandates. So most banks and investors and funds are having to turn their back on fossil fuels. You've got Biden, who is now saying that he won't allow new permits on federal land. So that's about 10% of new shale supply. People I really follow closely, like Rob West, Go Rosen, are fantastic. If anyone wants to dig into this in more depth, they've got a fantastic website where they go through all their blogs in depth, and another few people that are experts in the oil industry all sort of arrive at this conclusion that there is going to be a structural deficit moving forward.
Well, that's pretty brilliant. Yeah. I mean, you're right. The supply is going to shrink drastically, and the demand, you're saying, is going to pick up. So it just makes sense. And therefore, these very depressed offshore drillers could be a good value play. My one question about that, though, is okay, uranium, that's a great energy source too. Could that overtake oil, because it does have that baseload capacity?
No, so they're quite separate markets, really, when you consider, and it's also so oil gets really misunderstood in a lot of ways. When you mention oil, everyone just thinks of transport, and oil's emissions just from passenger cars is only about 14%. Oil use, total like air travel is only 7%. Like oil and the energy goes into an awful lot of things that we don't even consider, like making all plastics and products, and it's hugely spread throughout the whole economy. Agriculture is a huge user, and so when you consider that, it's the economy is addicted to oil is the easy answer to that, and there is no real way to wean it off. Even the EVs just really a rounding error and how many have been brought on. But to tie that to nuclear, like anyone that's following me on Twitter knows I'm an absolute massive uranium bull. But that's largely just because I see it as it's super interesting when you work out. It's pretty much it's its own sort of closed system. You can know the demand, so you know that there's 440 odd reactors in the world. There's 53 being built. You know that these are multi-billion dollar investments. There's no way that they're not going to purchase uranium when the time comes. They're going to keep the reactors on. And as a function of the way they work, because they rely on long-term contracts, which are all just starting to roll off. So these are sort of 10-year contracts. The long-term contracts have starved all the supply side. So all the miners have just been absolutely decimated. To give you an example, there was 500 odd companies in uranium going back to sort of the last boom, and now there's probably 50 odd. And so that's been completely cleared out, and there's going to have to be a rebalancing because the reactors are all having these contracts roll off, and there's not enough supply out there. Made simply, I don't know if I answered your question right. Uranium versus oil, it's quite separate markets when you consider oil as for actual electricity generation. Or oil is more the transportation and all the little bits and pieces, and uranium is just purely electricity generation. So uranium's more play against, say, gas renewables and just general growth in the energy supply. Like China's building the vast majority of new nuclear power plants.
I'm super excited about uranium too, and I'm currently going through the process of trying to find companies, and it is really hard because they're all like these dormant mines, and a lot of them are living off of diluting their shareholders and just waiting for the spot price to go up. So how are you kind of figuring out what to buy? And because what I love about your trading strategy, you're trying to find that big upside value play. So how are you finding that in the uranium mining market?
So I always go with what I think is the most de-risk play. So I'm like people always, if you're going into these highly risky sectors, you don't need to go into the most risky stock on top of that. That's just unnecessary in my view. So with uranium, the way I went about it, and I'm quite a well-known Paladin bull, it wasn't because I think it'll have the biggest upside. I'm sure some of the small, low market cap miners will outperform it. But what I liked with Paladin in particular is they already have a mine, so they just have to restart it, which is hard to stuff up. They sold a mine, so they have 4-year runway, so that you're not going to get diluted. All the overhead covered for 4 years out, and you also know what they can produce, so they can execute on their strategy. The management is well incentivized. They've got low salaries and lots of stock options higher to incentivize them just to push the stock higher. So it was really just a great risk reward play for me, and it's been playing out as such. It's been one of the better performers considering it's sort of what I view as its risk level.
Do you know how long it'll take for them to restart the mine when they decide to?
12 months, I believe. Yeah.
12 months. Okay. Okay. Yeah, it's Rick Rule's favorite stock too. And is that because of kind of what you're saying, just that, they have a mine, they have proven reserves, they just have to start it and get going? Because there are lots of other companies like that too, right? To pick from.
Yeah. Yes, there's quite a few that have mines and care and maintenance or their ISR, so they can get started quickly. But there's also quite a few that, like, one of the things to be really careful of in uranium is just people marketing pounds in the ground. It's to give you an example, in the last bull market, only Paladin went from being a sort of a developer to getting into production. It's actually super hard without a major's help. So some of the guys that got bought up by the majors got into production. It's super hard to get the permitting, to get contracts to develop the mine, as showed by just that number I was saying before. There was upwards of 500 companies, and only one got into production on its own, and only another handful got up into production with the help of majors. So once you understand that, you understand you've got to be super careful who you're picking, and that's why I really like what I call like the first movers. So yeah, Paladin, Boss, even Energy Fuels, I like them guys. They've got a very clear path to production. You don't have to have a whole lot of assumptions that things will go right for them to get in production.
All right, that's great. Great analysis. So you're saying Boss Energy, right?
Yeah.
And Boss Energy, they just bought a mine right off of a major, I believe, right?
Yeah.
That seems like a much more deep value than Paladin because I mean, Boss's market cap is like, oh, it's at 200 million and Paladin's like 300, so it's pretty close.
Yeah, yeah. But Paladins, they've got a history with utilities, so it's a very clean play. The thing it always gets a lot of hate. Got a big debt load, 2023, but I always went into it knowing that I always thought uranium was going to inflect a lot earlier than then, so it made sense. And once things really, the sector gets investors' attention and starts getting the love that we're seeing, then there'll be no problem for them to refinance that debt.
Okay, that sounds good. And I have to ask because I was really looking at this one, but what about Vimy Resources in Australia? Do you have any thoughts on that
Yeah,
one?
yeah. So there's a whole segment. So I own Vimy, but I own a very small amount of it. You have the first movers, so like the energy fuels, the Paladins, and the Boss, and then you have what I like to refer to as like the out of the money call options. So these are guys that really need the uranium price to overshoot to become economic. So the perfect example previously was Bannerman, even though they've now redone that project, but previously that they needed a uranium price that sort of was going to shoot through to $65 a pound, and they needed roughly $1 billion of capex to become economic. So it was something that was priced in the as a sort of a few cents. But if the if that circumstance occurred, they actually had a huge reserve and would become quite economic if you saw uranium completely overshoot that point. And so Vimy's in the same sort of pool to a certain extent. I believe they need quite a high uranium price to become economic. So I own smaller positions in them with the likes of Vimy, Forsyth, Bannerman, just a handful of these that I think those could be the ones that really give the very large returns, a lower probability.
I gotcha. Yeah, that makes sense. And it just proves how hard it is to figure this stuff out because it's like, oh yeah, this one needs $60 to be profitable, and this one needs this much, and it takes a lot of analysis. That's why, like, what do you think about the ETF, URA?
So don't touch that. Just
Really?
leave that completely. So that they butchered that ETF by moving it away from uranium miners. And if you look at the top 10 holdings, it's got gold companies, it's got engineering companies, it's got Barrick Gold. Like they're trying to rebalance it towards uranium miners now because their assets under management dropped massively. But I think the damage is done. You don't. If you want exposure to uranium miners, you can go with the North Shore Uranium ETF. That's just pure uranium miners, and that's well run. I wouldn't touch URA.
Okay, good to know. That's really good to know. So I guess, are you predicting an overall commodities boom to take place?
Yeah, yeah. I see it pretty inevitable. You can go across the entire commodity space. I think it was Jeff Curry. He said across the entire commodity space, you only had cocoa and I believe it was like coffee and iron ore that weren't in deficit. So you've got pretty much the entire commodity space is losing money at current pricing, and you really can't have that. What my overall big view when you step back is that we're at the top of a sort of a peak of valuation of financial assets, and we're going to go into a new cycle of the realization of the value of real assets because they've just you can look at any commodity chart, it's just been from the top left to the bottom right, and that can't go on. And if you looked at history, you understand that there are these big cycles, and inflation will likely be the driver of that, which most people don't think will ever happen again.
I mean, I think they're going to try to print their way out of the economic mess the world's in, and in doing that, that probably will drive all these commodities up. So are you not going big into silver or gold?
No, so I leave them alone. I don't mind silver. I just think my particular I like to be able to work out the demand picture, and with silver you can work out a certain amount with solid demand, but I believe that uranium and tankers and some of these offshore players will largely outperform silver, because to take gold's the easiest for me to explain. So gold's actually quite expensive historically, which I've put a chart up of it on Twitter before and got a lot of hate for it, pointed out to all the gold bugs that it's not actually very cheap historically, especially if you compare it to oil. So there's this great chart that Go Rosen have that is oil in ounces of gold, and it goes back a few decades. And what we have now is, so the standard sort of range has been between 10 and 30 barrels of oil to an ounce of gold, and we got up to 80 barrels of oil per ounce of gold. Obviously, halfway through last year, now we're sitting around the sort of 45, 50 level. So when you look back at the 70s, when I think there's a lot of sort of a lot of similarities that you can draw now, is that when we went into an inflationary period there, oil was actually quite expensive, and it still massively outperformed gold moving forward, outperformed it by about 7% a year, moving forward for decades. And now what we have is oil like ridiculously cheap compared to gold. And so I think the outperformance will be really something to behold. And so it's more just a relative value play. Like, I think if you're talking about gold versus Tesla, then yeah, of course, gold will do well. But I think oil, energy in general, will hugely outperform gold.
It does make a lot of sense. So you're saying in the 70s, which is what, most gold and silver investors point to as being the big period of inflationary prices. You're saying during that period, did oil outperform?
Yeah, hugely. So if you take it from, I believe you can take it from 1980 to 2020, I think, I believe gold's overall annual performance was 20% or so, and I think oil's 27, 28%.
Wow.
And that was when obviously gold was cheap and oil was expensive. Because the big overlay to understand what's happened recently is not only, how does best explain it? So capital's super important to the oil and gas space, and it's essentially been cut off by ESG. And on top of that, you've got a lot of the investment that has gone into oil and gas has actually been quite temporary. Like a good way to think about it is decline rates. So when you're talking about a conventional oil project, it's hugely expensive. Put hundreds of millions, if not billions, into it, and you get a 10% decline rate every year. So that's like an offshore project. Was this sort of the standard pre-shale. Now, when you consider shale, we've poured billions into shale, but with shale, everyone forgets that the first year you get a 70% decline in production rates, and generally it's most of them about 85% over the next 3 years. So they're actually quite short-term producing assets. So when these get cut off from capital, which is what ESG is doing, you only have to Google BlackRock ESG. They're divesting most of their funds from fossil fuels. You've got every day another bank like JP Morgan or Goldman Sachs announces that it's divesting from fossil fuels in some way. And so all of this is cutting off capital at the very time that we need to be pouring capital in the space to bring on supply, because of this structural deficit that's looming in the next year or so. And yeah, so that's kind of how I would explain it.
Wow, no, that's mind blowing. So you're right. So all these, corporate America is totally alienating it, and you're saying they're all just kind of missing the boat completely, essentially, right? Because they're leaving it. They don't realize how much we're going to need it and how much the price is going to spike because there's going to be such a demand for it, and there's going to be nothing to replace it, right?
Yeah, correct. So the one stat you can have is the is called the replacement ratio. So you currently, for every 1 barrel of oil we're using, for every 6 barrels of oil we're using, we're only replacing one. Or another way you can do that is you can forecast decline rates. So if you remember that little sort of example I ran through before with saying where developing growth is going, well, if you take oil supply now and you just let the decline rates play out and you don't find anything new or don't add anything, then by 2050, current sort of 100 million barrels a day will have declined all the way down to about 20. So on the back of decline rates. So it really is quite something when you consider what ESG is doing. And smart people realize this, but they can't do anything about it. You only have to read the likes of BP announcing they're divesting from all their carbon intensive projects and going into renewables and fire sailing some of their offshore stuff. It's because of shareholder pressure and ESG, and they might know that it's inherently silly. They're in a cyclical business, and they're gonna be punished for it in the next 2 or 3 years. But when shareholders don't care and are forcing their hand, then it's what they're doing.
Well, I guess it all depends on when the commodity boom happens, right? Because I was saying, okay, well, what you're saying makes sense, but it could play out over the next 3, 4 years. It could take time. But
Yeah.
if the commodity boom happens now, as soon, then I guess all bets are off. Everything will go up. But do you think it would take a few years for this to play out?
So I think it's always better to think in years. Like I always avoid saying this
Yeah,
will play out in a few months or 6 months. I've had egg on my face far too often from ever thinking I've got any accuracy over a time frame.
right.
It's yeah, like it's yeah, time frames are always super hard to figure out. So I just always take your time frame and double it at least to give yourself a margin of safety.
You gave us so much to chew on. I'm super excited. I'm going to do a lot of homework on this, and what you're saying makes so much sense.
So go to Go Rosen website and you can look up there. They've got the gold to oil ratio. If you just type Go Rosen gold to oil ratio, it'll come up, and they've written an entire essay on it, and it's super insightful. So
Yeah, totally.
highly recommend just have a read of that and consider that, and then also I can send you some charts on just the history of performance from the 70s on, considering oil still outperformed when obviously it was 1 ounce was buying somewhere around 10 or 20 barrels, whereas now we're 1 ounce is buying sort of 40, 50 barrels.
Well, thank you. How can people learn more from you? Where can they go to find you?
So just Twitter is really where I'm the most prolific. Yeah, I try and get through all my DMs. It's getting a little bit harder these days, but I will get back to you if you DM me. So I enjoy all the chats I have on there, and I also have a blog that I'm trying to build up the email list there because I'm not really liking the direction that Twitter's going with some things. So I don't know if that's forever going to be an option. So yeah, just those two really. Check out the blog or follow me on Twitter.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.